Tiffany. So we've just published our outlook for this forum, inflection. Can you give us an inside look at those key takeaways?
Yeah, sure. So I think it can really be summarized, very simply, in the sense that we've seen the peak pandemic that likely happened in April when 7-day new cases started to peak. But with that, we've also probably likely seen the peak in policy. So fiscal policy that we've gotten during the pandemic, that is going to start to be dialed back. And what we think that this means is that in 2021, you likely see the sort of desynchronized growth recovery between nations, but that leads off into 2022 where you get more of a synchronized growth moderation. And so what does this mean for inflation? Ultimately, inflation lags growth. So as you see growth peaking and this policy-induced demand peaking, inflation will also likely peak as well. Now I think that there's more question this time around the actual timing and the magnitude of that peak inflation as a result of some of these supply-side constraints, that have come about either within the semiconductor industry or around shipping and logistical bottlenecks within the United States.
Mark, given the three peaks in the outlook, can you weigh in on how these macro conclusions are being applied to portfolios today?
There are a few high conviction opportunities at this very, very moment. Valuations seem generally rich to us, and our approach is one of patience, focusing on liquidity and flexibility, and want to be positioned appropriately to capitalize on opportunity as it presents itself over our cyclical horizon. With regard to specifics on investment opportunities or market risks, we expect to stay pretty close to home on overall interest rate or duration positioning. The steepness of the yield curve and the backup in rates so far this year has created a nice carry and roll down at intermediate points of yield curves, not just in the United States, but globally, to be sure. We favor housing-related assets given the strength of housing in the United States and quite frankly, around the world. So opportunities in non-agency mortgage-backed securities continue. Agency mortgage-backed securities, which were a great opportunity for 2020, have richened to quite overvalued levels. And so we've reduced our exposures quite a bit, remain neutral. There's certainly still opportunity in some of the COVID-related or recovery-related themes, and we're seeing opportunity there. We do think that there are unique opportunities in emerging markets, though we're respectful of the importance of bottom-up research and security selection, because not all countries and not all opportunities are created equal. And then we're generally overweight equities. And given fair in a relatively rich world, it seems okay to be still slightly overweight equities given our macro views.
Moving on from this, Mark, can you talk about the role of fixed income at this point in the cycle?
The role of fixed income historically is a positive term premia, which gives you an expected higher yield or return than sitting in cash. There is some carry, and importantly, there is the benefit of diversification in an uncertain outlook. And while those three characteristics didn't necessarily hold a year ago, as we think about the cyclical horizon, those three characteristics are once again in place.
Many investors are worried about rising rates. Tiffany, what is PIMCO's view on rising rates?
So monetary policy, that impulse, if you will, is likely peaking. But looking a little bit further out, just because this policy impulse, that we call it, as peaked, doesn't mean that we think that central banks are actually going to be quick to start to, to remove policy or raise interest rates. So the Federal Reserve, for example, we don't think they raise interest rates until well into 2023. And of course, other central banks could be even later than that. So the ECB, of course, could be one that's later. So I think that's the thing to keep in mind here is although there is a policy peak that's happening, we think central banks will largely, kind of stay the course on interest rates.
Mark, in the case that rates do rise, which fixed income sectors can be expected to outperform?
Well, let's start off with a couple points. One, let's be clear, rising rates aren't always bad. Yes, they can negatively impact near-term performance, but rising rates can lead to higher levels of longer-term performance and longer prospective returns, particularly in the context of what Tiffany mentioned with central banks likely anchoring short-term interest rates at extraordinarily accommodative and extraordinarily low levels beyond our cyclical horizon. So rising rates aren't necessarily bad. Higher rates, as I mentioned earlier, may potentially provide protection against downside risk in a broader asset allocation. And as we look around the world, there are opportunities where interest rates have already risen and create some opportunities. So we'd encourage investors to think about bonds from a global context, not just one particular country or opportunity.